Hello and welcome. My name is Melissa Galasso, and today we're going to discuss ASU 2023-08, which is related to cryptocurrency or crypto assets. This is a very interesting topic. It's something that the users of financials, as well as others, have been asking for a better guidance on. Current guidance with respect to digital assets is not very helpful for many people. First off, unless there is industry-specific gap, these are kind of in a weird classification. So even if they are called cryptocurrency or digital assets or crypto assets, they are not currency, right? They're not issued by the federal government, so you can't use the rules around cash. You also can't treat them under any of the traditional financial assets categories because it doesn't give you the right to cash. It doesn't fit under the concept of inventory. And so they actually fall under the concept of just an intangible asset. And these intangible assets are going to be at cost less impairment. And so not very helpful if you have Bitcoin and it's going up and down and you're parking it on the balance sheet and you're leaving it at cost unless, again, there is an impairment. And so you can only adjust down but never up for the value. And so many people ask the FASB to take a look at this and to try to provide a little bit additional guidance here. And so this ASU is going to answer the requests from many organizations. So ASU 2023-08 was issued in December 2023, and it is accounting for and disclosure of crypto assets. And so as we look at this, if you go back to the invitation to comment on the agenda consultation, this was number one with requests from not just users, but also preparers as well as auditors looking for better guidance on how to really look at the economics of cryptocurrency. Now, the first thing about the standard is that you do have to be in the scope of the standard. And so first and foremost, you have to meet the definition of an intangible asset. And so as we look at the initial definition here, right, that's where they're currently sitting. In addition, it does not provide the asset holder with enforceable rights to or claims on underlying goods or services or other assets. It has to be created or reside on a distributed ledger based on blockchain or similar technology. That was a change that they made between the exposure draft and final. The original exposure draft only talked about blockchain, and many people pointed out, who knows in 5-10 years if there's going to be something newer or better than blockchain. And do we really want to have to go back and amend this standard for changes in technology? And so they added or similar technology so that we were able to make sure that we are not having to go and make changes for changes in technology. They have to be secured through cryptography. It does have to be fungible. This is one of the things that kicks certain crypto out, especially NFTs, non-fungible tokens. They are by definition not fungible. And so as a result, they are not within scope. So fungible is sort of like a dollar. A dollar is a dollar. So if you have $1, you take another dollar, you can switch them back and forth and nobody will know which the original dollar was. Non-fungible tokens are unique, and so they are not within the scope of this particular standard. And then they are not created or issued by the reporting entity or its related parties. So long as you're in the scope of the standard, we are going to provide you with 3 areas of focus. We're going to provide you with subsequent measurement, disclosure, and presentation rules. What we're not going to provide is initial measurement. So while the exposure draft did provide initial measurement guidance that was very similar to what you would find for financial assets, that it was supposed to be at cost, and that would not include any type of transaction costs, like if you had a broker cost, etc. They decided in the final standard not to provide that guidance. So it does not address the initial measurement, recognition, or derecognition of crypto assets. In the accounting for initial measurement, recognition, and derecognition would be in accordance with other gaps. So they are not going to provide that guidance in here. They're going to just reference you out to other guidance. But they are going to provide guidance on subsequent measurement. And so instead of sitting on the balance sheet at cost minus impairment, they're going to now measure crypto assets at fair value, and that gain or loss would run through net income. So that is obviously what everybody wanted to see, which was a fair value measurement, and obviously running it through net income makes sense given the type of assets that they are. Now, from a presentation perspective, we do have some pretty important guidance here. You are required to present crypto assets separately from other intangible assets, so you can't lump them together with other intangible assets. You have to be able to see them separately, and you can present crypto on a more disaggregated basis by, for example, for types of by individual crypto holding or intangible asset classes, but you have to, at least in the presentation, show those separately from other intangible assets. And so we have to be able to see exactly how much crypto there is. And those gains and losses that we're going to run through net income, they have to be presented separately from the changes in carrying amounts of other intangible assets. So we have to be able to, again, see the specific amount of adjustment that's being made for fair value adjustments for crypto specifically. Now, in terms of the cash flow statement, again, in terms of presentation, if you do get cash receipts from the sale of crypto that are received as non-cash consideration in the ordinary course of business, or as a contribution for not-for-profit organizations, and they are immediately converted to cash. What we hear a lot of right now is, I got a donation of crypto, we don't want to have crypto, so we sold the crypto. In this scenario, they are going to provide guidance that that would be deemed to be an operating activity, unless under not-for-profit accounting it was restricted to some long-term purpose. Then obviously it would be a financing activity. And the definition of converted nearly immediately is a very short period of time, within hours or a couple of days. We're not talking weeks here. We're talking immediately, right? So couple of hours, couple of days, okay. Once we're getting into a couple of weeks, not okay to be nearly immediately converted. And so if you're getting this and you really don't want crypto and you immediately convert it into cash, then in that scenario, we would treat that as an operating cash flow. All right, so what about disclosures? So at interim and annual, we're going to provide for each significant significant crypto asset holding, which should be determined by fair value. So if it is significant based on its individual fair value, you're going to name the crypto asset and provide the cost basis, fair value, and number of units held, right? So if it's significant based on its fair value, in that scenario, you are going to disclose it separately. If it is not individually significant, then you're going to provide for the remainder the aggregate cost basis and fair values of the holdings that are not individually significant. So you're going to lump them together and say, okay, here are my other crypto, here's the cost, here's the fair value. So obviously you don't have to talk about the number of units or name them, because you're just going to aggregate those remainders. All right, so that was for interim and annual, but what about just on an annual basis? So in addition to the disclosure that would be provided on interim, you would also provide on an annual basis the method used for determining your cost basis from computing gains and losses. Specifically, is it first in, first out? Is it specific identification, average cost, etc.? So how are they doing that cost basis? And then if not presented separately, the line item in which those gains and losses are reported in the income statement. We would also provide a reconciliation, which was very much requested by users to understand the activity with respect to crypto. So you would have your opening balance, and then what did you buy? What did you sell, right? Your additions and dispositions. What are your gains included in net income in the period determined on a crypto asset by crypto asset basis? And then losses that are included in net income for the period determined on a crypto asset by crypto asset basis as well. Now, as you go through this, this is just to understand the volume of activity here, right? So we want to see what's the amount of purchases, the amount of sales, and the amount of adjustments that are being made here as we go through it. In addition, we would describe the nature of the activities that resulted in additions. Were they purchases? Were they receipts from customers? Were they mining activities? Where did those additions come from? As well as what were the dispositions? Did you sell them? Did you use them as a payment method, right? Just to have an understanding of that type of activity. So we have the additions and the disposals, but what kinds of additions and disposals? And then the total amount of cumulative realized gains and cumulative realized losses from dispositions that occurred during the period. So again, we're just trying to have a good understanding of the flow and adjustments being made here. Now, if you did receive crypto assets in the ordinary course of business and then converted them into cash, you do not have to provide that reconciliation and related disclosures for it, because again, the intent was not to have crypto. You just accepted the crypto, but then you converted it into cash. So we would give you an exception for those disclosures. And then last but not least, if you have crypto assets that are subject to contractual sale restrictions where you aren't allowed to sell them for a period of time, a lockup or some type of other agreement, similar to what our other restricted asset disclosures are going to be on the interim and annual, you would write the fair value of the crypto assets that are subject to restrictions, the nature and remaining duration of those restrictions, and then the circumstances that could cause the restrictions to lapse. So again, this is the same exact requirements that we would have for any other restricted assets that we have in our financial assets area. This is just bringing that over for crypto. This is an interesting standard because there's no difference between public and private. All entities are going to adopt this standard for fiscal years beginning after December 15th of 2024, which would be calendar 25 and fiscal 26. However, early adoption is permitted, including for those that have not yet been issued. So if you have an open 6/30, for example, year end, and you want to move to fair value, you could do that in December 2023 when this was issued. All right, so that is a wrap on ASU 2023-08, hotly waited for. Many people were very excited to have it out there, so glad to see it come in before the end of the year. So thank you for joining me, and I hope to see you on a future Nano Learning. Have a great day, guys. Bye-bye.